I'm going to take some time to talk about liquidated damages so you know again what it is, what it isn't. Well, liquidated damages are an appropriate disincentive. As discussed later, number one, frequently they are hard to calculate. So in liquidated damages, you must say what the value of the damage is. You must say it in your specification or your contract. That means you must calculate it. If you can't calculate it, then you may have difficulty saying that you have a liquidated damage. Even if you calculate it, a vendor can still make the accusation it is a penalty. And even though they do not object to it, when you go through your procurement and you make the award, that doesn't say that if you ever try to apply it, they won't at that time say, wait a minute, this is a penalty. And they can file a claim against you if you withhold money that they claim as a penalty and you say is a liquidated damage. And we deal with claims in the perform class. Vendors, and this is the other thing. In fact, I just had a discussion with this yesterday on a contract within DBM. Vendors can determine it is less expensive to pay a liquidated damage than to fully perform. And let me amplify that. Since liquidated damages must be specifically stated in the RFP, they have the unintended consequence of giving the contractor a fixed target to make a financial decision on whether to perform each such aspect of the contract, i.e. the contractor can make a dollars and cents business decision of what costs less, doing the contract or paying the liquidated damages. If you say it's $50 a day for not producing a report, and for them by a certain time frame, and for them to produce the report by that time frame, they're going to have to put extra people on the job and pay them overtime, etc. So meeting the time frame, we may have to pay $500 extra in personnel cost. Not meeting the time frame, we pay $50. We have $50 deducted from our final payment. Well, it's cheaper to pay the $50 than to pay $500 in expenses to meet the time frame. If we have a liquidated damage, we've told them what the damage is so they can make that determination. And theoretically, allowing them to pay the liquidated damage is okay. So we can't say, okay, we're going to take the liquidated damages from you and we're still going to hold you in default of the contract. We've told them that that makes us equal if you pay this amount of damage. So if they pay that amount of damage, they're equal. It's the same as if they would have produced the report by the time frame. So that's what you have to consider. And the whole thing of liquidated damages is very complex and very confusing and aggravating, but it's there. It is an opportunity, so you need to focus on it and decide what to do and what not to do. Contract performance does not help if vendors decide to simply pay the liquidated damage. The liquidated damage may not be a sufficient disincentive to positively affect the contract performance. That's a reality. And I know the knee-jerk reaction is, well, then we have to make it painful enough that they're going to perform. But then that runs into the second thing is, I guess, which is not the second thing, probably the next slide, but it can't be a penalty. We can't make it be so harmful that it exceeds the value of what they have not performed. So liquidated damage may incentivize vendors to not perform by giving them a finite cap of how much they will lose by not performing a particular aspect of the contract. Liquidated damages cannot be an arbitrary penalty. They cannot be constructed to make non-performance of a contract so painful to a vendor that the vendor will perform. Deductions can only be commensurate with the actual harm done by the non-performance. That's what liquidated damages are. So if it is not acceptable to the agency for a contractor to pay liquidated damages in lieu of performance, and if the appropriate level of liquidated damage, i.e. the level that is commensurate with the actual harm and not a penalty, is insufficient to spur vendors to fully comply with contract requirements. This is building up a premise. Other measures have to be relied upon to help assure full contract compliance. What I'm saying is You can't put all your eggs necessarily into the liquidated damages basket. You have to construct your liquidated damages properly. You have to figure out what is the harm to the state if a vendor does not meet this requirement, per day, per hour, per whatever. And you cannot specify a damage that is in excess of the harm. And if you say to yourself, but that's not really that insignificant that probably a vendor can easily ignore it and just forego the amount of the damages, and I want performance, then what I'm saying is you have to focus on other than simply liquidated damages to try to incentivize the vendor to do what you want them to do by the time you want them to do it. So let's see some other things. These are other things that you can specify, all towards the objective of trying to get the vendor to perform. Have exceeding a specified number of instances of collecting on liquidated damages trigger some additional contract requirement that will directly or indirectly have a cost to the contractor, i.e., we will deduct $50 a day from you if you don't produce a report by this date. But as of, as of the 5th day of non-performance, in addition to the $50, we will require a corrective action plan, remediation plan from you. We will require you to come in to the state premises to meet with us to explain in person why you have not met the deadline and what your plan is to produce this in an accelerated time frame. Or depending on the circumstance, we can say it's going to trigger an audit. It's going to trigger them having to do a survey of satisfaction, something like that. Something else that will be required for them to do that is going to cost them money, not necessarily money that they're going to pay the state, but it's going to cost them money to do it. If they have to go out and pay for an audit, that's going to cost them money. If they have to send a satisfaction survey to 400,000 medical assistance recipients, it's going to cost them money. If they have to fly in from Michigan to an on-site meeting that is attended by specified people from the company to explain why they haven't met it and how they're going to get in time frame, it's going to cost them money. Though these may be in addition to purely a liquidated damage, and yet we're not saying it's a damage. We're just saying, and these have to be in the specifications to begin with. You anticipate, you write them in there, and then if you get to those occasions, then you say, okay, we said it in the specifications that if you had 5 instances, this was going to happen. Now it's going to happen. Come do it. So just think about it. All the above plus other actions such as are described in a number of the following slides are discussed in perform. We discuss a lot of things in perform. If the contractor has a performance bond, and this is something that I'm throwing out as just something that can be done. If they have non-performance and they have a performance bond, you can write to the surety that has issued the bond. You can, well, you don't write directly to the surety, you write to the vendor and you copy the surety. And you tell them about the non-performance. And vendors don't like for their surety to know about problems, because what the surety does is they're writing a bond, which means it's like an insurance policy. And what a bond means is if there is a default situation, the surety is going to pay a specific amount of money. Either that or they're going to bring in another contractor to perform in lieu of the one that's not performing. So it's going to cost the surety money if there is a performance issue with the contractor. And if that happens, it's like we talked in the first day about risk factors. If a surety has had to pay on a bond, the next time the vendor wants to get a bond, either they're going to be denied the bond or they're going to have to pay more for it. So something that says if there's non-performance that you write the vendor and you copy the surety may spur the vendor to perform, because they don't want the surety to think that they're going to be a risk on other bond situations. Yes?
Do you have a threshold in mind for this, a dollar threshold or a...
Did I have a threshold in mind? No. I didn't have a threshold in mind. I didn't have how many occasions. What I'm simply throwing out is things that you can do. Now, this does not necessarily have to be written into the specifications. The one on the prior slide should be. That they have to do a survey, they have to do an audit, they have to come in for a meeting. Those type of things should be written there. This, just saying, okay, it's gotten to the level, I'm going to now write you formally in writing and copy your surety, is something that you don't have to write in the specification. You can, but again, you're not going to necessarily know when. But it's something that you can have as, in the planning stage, just plan, this is something we're going to do if it gets to that level. You're going to implement it in the perform stage, but it's something you can anticipate at this stage.
Was your question more directed towards when should you have a performance bond?
No, I
and
know
when
that.
when should you not?
I just wanted to know, no.
Because generally we don't have performance bonds.
Generally.
In our stuff.
Yes. For services, primarily we do not have performance bonds. Doesn't mean you can't, but primarily for services you don't. They are required for construction. They frequently happen in maintenance and things like that. It depends on how tangible the activity is and how many other vendors there are that do this and other factors. We discuss bonding. We're going to have a separate one-day class on bonding and insurance. So we discuss a lot of the details, obviously, in that class, but just throwing out that this is a possibility. So you can read that. Let's see. Another possible triggered action, the contract provision granting the state the right to terminate the contract for convenience without paying the contractor incurred expenses. Now, this is something that I'm going to emphasize. This is something you do need to write in your specifications. And what this is, because one of the things we say in Performed is there are 3 ways a contract can be terminated by the state. When I say terminated, it isn't just ending because it's time to end. Either what has been required to be performed has been performed, or the required time frame has been satisfied. And those 3 ways are convenience, default, and lack of appropriation. Lack of appropriation, I don't think I can remember in my 31 years a time when we ever terminated a contract for lack of appropriation. So even though it exists, it isn't something that's typically going to happen. So that reduces it to default and convenience. Default is convenience, let me turn it the other way. Convenience is we can terminate a contract for whatever reason we have to terminate a contract. We can decide 5 days after we award a 5-year contract we want to terminate it because we just want to. Don't have to have a reason. And we have the right to do that. Now, the vendor for a termination for convenience typically has the right to go after us for what are called incurred expenses. What they invested to do the contract that because we're terminating, they won't get paid for. Not things that they expected to make as profit, or not things that they haven't spent any money and so they're not out anything other than the expectation of profit, but actually money that they have spent that now they will not get reimbursed for. So they can go after incurred expenses. So that's one of the reasons not to do a termination for convenience, and we almost never do a termination for default because frequently it's hard to prove it. And frequently we do a very inadequate job of documenting the non-performance. And one of the classes we would have had, but one of the examples we would have had, but we're not going, well, actually it's in the Perform class, is of a circumstance where a state agency terminated a contract for default, and when the vendor filed a claim and it got to the Board of Contract Appeals, the Board of Contract Appeals agreed with the vendor that the situation was not a default situation. So the Board of Contract Appeals changed the termination from a termination of default to a termination for convenience. If you don't have the proper justification to terminate for default, it automatically is a termination for convenience, which meant then the vendor is entitled to money. So what I'm saying here is you can have in your specifications that if the vendor has 10 circumstances of liquidated damages, or something of that nature, that the state will have the right to terminate the contract for convenience, not default, for convenience. However, in that circumstance, the contractor will not have the right to go after the state for incurred expenses. It is a contractual provision. And so you can then get to the situation, if you want to implement that provision, you can do it. So this is just something that you can use as a non-monetary disincentive, putting that in the contract, and assuming the vendors bid to that, and it's in the contract, you have the right to do it. So that's something most of you would never think about. And it's something just saying that you can think about. It's something you can write in there.
Can you write something like that for small procurement?
Can you, small procurement, can you? I guess you could. But the reality is, in small procurement, you don't even have to have clauses. You can have a very abbreviated termination for convenience clause, but you don't have to have a termination for convenience clause in a small procurement. So, I mean, I've never gotten to something like that for a small procurement. All right, threats of termination for default or convenience may not be the best option. So, let's see. Number one, there may not be sufficient grounds for default. Number two, as I just explained, unless you had some of that language, we got up here, or I guess, over there. Unless you have the provision I just described, a termination for convenience may cost money, and so you may be dissuaded from doing that because of the potential expense. So just saying to the vendor all the time, and one of the things I frequently see in specifications that I frequently say, take it out, is all kinds of threats in the specifications about termination. If you don't do this, this will be grounds for default. If you don't do that, this will be grounds for default. When I usually go back to the agency and I'll say, let's get real now. If that vendor doesn't do this, are you going to default them? Well, no, because if they don't do it and you default them, you have no contractor to provide what you need. And usually, since this thing frequently is said 5 or 20 times throughout the solicitation, it's said for things that sometimes are trivial. And you know, and the vendor knows, that you're not going to default them for something that's trivial, especially when you have no one else ready to step in after the vendor. So why make a threat that everyone knows you're not going to follow through with? I mean, my philosophy is say what you mean and mean what you say. That's the best course of action. Don't say you're going to do something that everyone knows you're not going to do, because then they're never going to know when you really mean what you say. And if you say something, do it. Because otherwise the vendor's going to learn that you don't mean what you say, so they can ignore what you say. And that's your situation. And sometimes that's the whole crux of the problem. It's we contribute to a vendor not performing by what we do or don't do in terms of sending messages to the vendor, contract performance, etc. So threats, I don't like threats unless you really mean them and can follow through on them, and everybody understands that. All right, we know, and probably this is the point for many of you to laugh, 4 months or longer to do a new contract. And many of you are going to say, 4 months? What contract can you do in 4 months? If it's a service, you're talking about 6 months. We'll have to see. I mean, you may already have the specs in place, so all you have to do is go out. But we know it takes a minimum 3-4 months or more to do a new procurement. And if you need service, you can't have a break in service, you're not going to terminate because you have nobody to follow through. Threatening to do it isn't going to happen, especially if it's unanticipated. So what probably is going to happen is this thing right here. So the agency likely will endure continuous marginal performance before it will terminate. They'll play the brinkmanship game, just doing enough so that you don't default them, that it doesn't get you so worked up that you're going to default anyway, but you still have very marginal performance, And that's what we're trying to avoid with these other things, these other disincentives that you can apply other than just threatening termination. Unless you get to a true emergency. If it's a true emergency, you can go out and do something theoretically in a day. Theoretically. But even if it's a service, and even if it takes 2 weeks, 3 weeks, that's still a far cry from 4 months if it's an emergency. And we discuss emergency in an overview, but the reality is it has to be unexpected, which maybe a termination is unexpected. But the other thing is there has to be an actual harm to the state, and there has to be something that has to happen right then. So if you think a termination is justified and you can turn to an emergency to replace a vendor, you're going to go, number one, to your procurement officer first, and number two, your attorney. Before you do any termination, you're going to discuss it with your attorney, you'll discuss the ramifications, and you're going to discuss it with your higher echelons. This is not something you're going to undertake casually, but you're going to make sure that what you plan to do after the termination is something that's supported by your management and your attorney. Okay. Perhaps the most effective disincentive is the threat of losing future business. As was said, an available renewal option won't be exercised. For this to be an actual disincentive, we actually have to implement it when it's appropriate to implement it. How many people here have ever not exercised a renewal option? 2 hands. How many people here have exercised a renewal option even though they would rather not have had the same vendor? Would not have wanted to continue with the vendor? Well, at least 3 hands to 2. How many people have never done anything? All right, that's a joke. What we say again in Perform is you should make an actual determination of whether the contract should be renewed. And if the vendor isn't performing, and if despite the things that you've done to try to get performance they're not performing, then you should not renew. And if that means that 4 months, 5 months before the expiration of the current term, you do another procurement, then that's what it means. That is definitely a point when the vendor will get a message if you issue a new solicitation. Because the reality is you can issue a new solicitation before you've said anything about not renewing the contract or renewing the contract. One of the things that I say, and actually I don't think it's in the slides, maybe it is, I think it is somewhere in the slides, but anyway, lots of times people want to give a specific minimum notice to vendors of whether they're going to renew, such as 30 days, 60 days, 90 days, etc., in advance of the expiration. General thing is we say is, number one, you're not required to, so number two, you shouldn't do it. Because what frequently happens is if you say, we will give you at least 60 days notice, you're going to miss that 60 days. And maybe the 59th day or the 58th day or something like that, you're going to realize you missed the 60-day notice, and you're going to say, oh, I want to renew. If the contract says you must give 60 days notice and you don't, that right has now expired. If the vendor does not want to continue to perform, they are not required to. They are off the hook. And theoretically, and this can go to the lawyers, it might even be that you no longer, even if you want to and the vendor wants to, you may no longer have the right to do that. If you don't put anything in there, then the only thing that has to happen is before the expiration of the contract. You have to say whether there's going to be a renewal. And so you can threaten a vendor, and you can say, you know, if you don't straighten up, and if you don't start performing, I'm not going to exercise the renewal. Okay, yeah, we'll do better. And they do a little better for a couple weeks, and then they slip off again, etc. If you say, okay, and then you issue a solicitation, they will get the message you're serious. And although I'm going to say this is something you can do, I realize this is something that is not without difficulty. you can issue a solicitation while you have a renewal option, advising in the solicitation that there is an available renewal option that you still have the ability to exercise, and putting every vendor, potential vendor, on notice that despite them submitting a bid proposal, etc., the decision may ultimately be to exercise the available renewal option. Then you can do a procurement at the same time as you have a available renewal option, and on the basis of the responses of the bids or proposals, then decide which should you do. Follow through and award under the procurement you've just done, or reject all the bids or proposals and exercise the renewal option. So you have that ability. Most people will not do that, because I'm not going to do a procurement and then not make an award after it because it's too much time and effort. But you have that ability. And if things are serious enough, that's something that you can tell a vendor, I'm going to go out and do a bid or a new procurement, and if I get something half decent, then you're out of here. Yes?
Wouldn't it be better to do a multi-year contract than renewal, so you can always cancel if you don't want to continue, right?
You can always do a termination for convenience.
It would save you a lot more work than having to renew every year.
Well, you can do, what I'm talking about is if you have renewal options.
Okay.
Because you can make a contract for 1 year with renewals, 2 years with renewals. In fact, we deal with that later in this class. But if you have it for a flat duration, and you want to get out of the contract, again, you only get out from termination or convenience. Whereas if you have it for a shorter term with renewal options, you can simply not renew, because it is unilateral on the part of the state whether you exercise the renewal option. So that can be your reason for not renewing. And if it is, you need something in place if you need performance after when the contract expires. There was another hand? And Gary wants to say something.
In that, if you do choose to put this out again, you can and probably should disclose the costs that you would have to pay for the renewal of the current contract. That's public information. So that the vendor community has a number, a target, which they'd never had before in doing this.
All right, let me say this to that. Let me answer that question first.
My question is, do the specifications in the new request for bid or request for whatever it is, do they have to be the same as the original?
No.
So you can change the
Yeah.
requirements,
The-
but then that number he was just talking about is obsolete.
The same, what I've been saying for 2.5 days now, unless you are absolutely 100% satisfied with what you have done to this point, your specifications, and there's nothing you can think of to improve those specifications, then you don't go out with the exact same specifications. You'll make whatever improvements you think are appropriate whenever you do a new procurement. It always should be a, what do you call it, continuous improvement? There always should be continuous improvement. And I don't think of any circumstance where I've ever done exactly the same thing. There's always something you can do better. Now, the issue of price. You should make available what we call high-level pricing. For instance, if you got just simply a fixed price, let's say $100,000 to do a project, then you can disclose to anybody that it was $100,000 to this vendor to do that project. However, if you got the $100,000, but you had the vendor bid what I call for intermediate deliverables, X amount to do this part of the overall project, X amount to do the second part of the project, X amount to do the third part of it. There is a lot of, well, for the most part, if the vendor says that their intermediate prices are confidential, for the most part, we will uphold that confidentiality. Unit prices, depending upon the circumstance, may or may not be disclosable. If the unit was the only basis of bidding, it's disclosable. If the bottom line price was the bottom line basis for the bidding, it is disclosable. But just because you disclose the overall, the 100,000, does not mean that you even have the right, if you want to, disclose intermediate prices from that vendor. And that's something that's governed by the Public Information Act. If you took the Procure class, we went over the Public Information Act. So what you will do is you'll go to your Assistant AG, and with the Assistant AG, number one, should you put that information in the solicitation? And even if you don't put it in the solicitation, you should have already discussed, if we get a request for it, which typically you will, can we divulge it? And in the planning, you can decide, what are we going to divulge in the solicitation? What are we going to divulge if we're asked, even if we don't put it in the solicitation? So, does that answer that question? Yes, sir.
In multi-year contract, to say, under small procurement, agency does a contract for 20,000 and with the renewal for up to 3 years. So say agency has a delegate authority up to $25,000. So this contract will be come under the agency, or it will go to DGS?
Go to DGS? All right, question.
Amount is exceeded.
All right, I will repeat it and you tell me whether I'm repeating it properly. Number one, you have a small procurement, and it's a multi-year small procurement. Now, the first thing I'm going to ask you is, for all the potential years, because you're going to have a base term plus renewal options, that's what you said, is the potential for all years of the contract, including renewal options, still less than 25,000?
No. Then it will be said 60,000 for 3 years.
Then it's not a small procurement.
Okay.
That's the first thing. Small procurement means for the total availability of award under the contract has to be less than 25,000. It isn't that you have a base term that's less than 25, and then you can do renewals that are 5 or 10,000 apiece, so that you should not be able to get to 60,000 in a small procurement. So that's why I was trying to find out. But if it's, let's say, 4,900 per year, and it's 1 year with 4 renewals, so that in total it's still 24,000 something, then yeah, it's a normal thing. You can exercise the renewals, not exercise the renewals, it's still a small procurement. Any other questions or points? So where are we? Let's see. Threat of losing future business, available renewal option. The vendor may not be selected again when the same contract is recompeted. If you have advised them of non-performance, whether you don't exercise a renewal, whether you put up with it for this time and simply go out again, the question is, were they aware that you were not pleased with their performance? And that is key, and we discussed this in Procure, you've got to let them know. I've had instances, and I quote a particular instance in Perform, where when I was here, in fact, at the health department, I had a facility that came to me and wanted to terminate a vendor for default. And okay, tell me all the circumstances where they have not performed. So they told me all kind of horror stories about what the vendor wasn't doing. I said, okay, now show me what you put in writing. And in this particular instance, it was a housekeeping contract. And there were weekly surveys of the cleanliness of the facility. And so they gave me all the weekly reports that they could find. And every one of them had as a summary, as far as the job the vendor was doing, either fair or good. And I've said, then what's the default? Well, I don't care what those written reports say, they weren't doing the job. Well, I hate to say it, and I didn't say it like this, I don't care what you say you don't care about. What's going to matter if this goes to the Board of Contract Appeals is what is in writing. And if in writing you cannot document you've ever told them that they are not performing, and told them, and at least given them the ability to have a rebuttal, you're not going to win. And if you're not going to win, don't fight the battle. That means either you're going to terminate for default, for convenience, or else you're just going to keep doing what you're doing, except from this point forward, start documenting and don't say what you don't mean. And say what you mean. If they're not performing, put in the evaluations they're not performing. And somehow the people just don't want to get into messy situations, so they don't want to have confrontations. So it's easier to tell a vendor you're doing a fair job than to tell them they're not performing, and it's going to come back to haunt you if you ever try and do something about it. Pay me now, pay me later. We deal with that extensively in Perform. Let's see, the non-performance of a contract with one state agency may...
Oh, okay, just wanted to ask a quick question. You said the vendor may not be selected again when the same contract is repeated. So if the vendor shows poor performance and say you issue another solicitation, if that vendor submits a proposal, do you have to evaluate? And then when discussing past performance, that's when you say no? Or do we just send it back and say?
Question focuses on this aspect. So you can't, you choose it's not appropriate to terminate, you put up with them, you do another procurement, then one of the things that you should have been saying to them, you know this is going to have an effect on whether you are selected when we go out and do this again. And the question sort of gets to what degree, how can you implement this? You may not be selected again. And what that means is you basically are telling them that we're going to determine you're not responsible. You're not capable, reliable, or with integrity. One or both, one, two, or three, all of those characteristics. Typically, in that scenario, either they weren't performing because they don't have the capability, or because they don't have the integrity, or they don't have the reliability, or more than one. You are required as the procurement officer to make a determination that any vendor that you want to make an award to is responsible. You are not to award a contract to a vendor that you have not determined is responsible. Now, generally, and I think I discussed this in Perform, we do that by an exception. Unless you have a reason to find them not responsible, by default you find them to be responsible. But if they have not performed, particularly if they have not performed on a contract for you, and you know that you have documented, because at some point, if for this to have meaning, you have to have told them this is a possibility. You know we're going to take this into consideration when we go out and do this again. Then when you do a procurement again, then you have to, can you stop them from submitting? No, you cannot stop them from submitting. Unless they have been debarred, which is an entirely different scenario that you have no ability to debar, only the Board of Public Works can debar a vendor, that unless they're debarred, you cannot prevent them from submitting a bid or proposal. If they submit it, if it's a bid, you're going to open it, and regardless of whether they're low bidder, you can determine them not to be responsible. But again, they can file a protest if you find them not responsible. So you need to make sure that you have your justification for why you would do that, and before you would make that determination, you're going to talk to your attorney, you're going to give all the documentation to your attorney, and see whether he or she is comfortable with defending a protest if the vendor says, I think you're biased against me, it isn't that I didn't perform, you just don't like me, etc. Do you have sufficient information? If it's a proposal, again, you can find the vendor not responsible or the proposal not reasonably susceptible, but if the vendor isn't performing, that is not an aspect of the proposal, that is an aspect of the contractor. And so you're still talking about an issue of responsibility. And what you, in that situation, you still need to evaluate the proposal, unless, if you categorically, before you even get to the proposal, are willing to say the vendor is not responsible, and your attorney supports that, you can, without evaluating the proposal, inform the vendor immediately that they have been determined to be not responsible. A determination of responsibility, saying they're not responsible, is not curable by the vendor. Now, that may sound a little strange if you were in the procure class, I said issues of responsibility can be cured after a submission due date. That's if you don't have information that lets you make a determination of whether a vendor is responsible. But if you already have experience with them, and you already know from your experience with documentation that you are ready to make a determination they are not responsible and nothing they can do.
They can't protest?
They can protest it.
You better have the documentation.
That's the whole thing. Anything you do, if it's at a new procurement stage, it's a protest. If it's when a contract is in effect, it's a claim. Vendors can always mess up the works by filing protests, filing claims, etc. So some of the times, though, we have to bite the bullet and just follow through, because if we never do it, it's just going to keep encouraging them to do the marginal performance. And if we do it, it's going to be the time and aggravation on our part. So can you find them not responsible? Yes. But you better make sure that you have everything, all your ducks in a row. And I can't emphasize enough, have your attorney on board and have your management on board. Now, it may not be something that the secretary, deputy secretary, whomever cares about, but if it's a major contract, this is going to go to the top before you're going to do it. And lots of times you're going to look at what is the potential for protests, and sometimes you're just going to follow through, and if it's sealed proposals, you may not say they're not responsible, but you may get to the point that they're not reasonably susceptible. That goes a little bit into some of the other classes. But again, you need to make these things aware, and you need to sort of plan. This is what we're going to do. We are prepared to go through these things, and so we need to communicate to the vendor, and that will help provide the disincentive for them to not perform. So these whole things go together, all these things that are written into the contract and all the things that are not written, but you can do despite that. And the last one, the non-performance of a contract with one state agency may cause the vendor not to be selected for contract with another state agency. For evaluated procurements, competitive sealed proposals, particularly competitive sealed proposals, I don't think we've done it for multi-step. We recommend the inclusion of a requirement for vendors to provide all contracts currently being performed for state agencies or that have been performed over the past 5 years, and the clause is on the next slide. With this information, a determination can be made if a given vendor has a history of properly performing state contracts or not doing so. And here is the clause. If applicable, the offeror shall submit a list of all contracts it currently holds or has held within the past 5 years with any government entity of the state of Maryland. For each identified contract, the offeror shall provide state contracting entity, a brief description of the service goods provided, the dollar value of the contract, the term of the contract, whether the contract was terminated prior to the specified original contract termination date. Did somebody terminate for default or even convenience? Whether any available renewal option was not executed. The state employee contact person, who in that other state agency do I contact to find out what they say about your performance? The information, and we specifically tell them, the information will be considered as part of the experience and past performance evaluation criteria in the RFP. That is the clause we use. That's the clause we've been recommending for something like 5 or 6 years now. Yes?
Yeah, slide. Don't show up.
Another one where the actual slide,
It's in all of our procurement.
it's in all your procurements. It's all DBM procurements, I know that. Now, there's caveats. Everything has the fine print. If vendors consistently see this clause in state solicitations, they will get the message the state agencies communicate with each other, so they may be more concerned about proper performance on all state contracts to prevent a poor reference from one or more state agencies from impacting their ability to win other state contracts. Care, here's the caveat, care must be taken to assure that any negative reports by a state agency is discussed with a vendor, and the vendor has the opportunity to rebut the negative assessment. Just because another agency says, no, they screwed up, I wouldn't hire them again. You cannot take that at face value and use that as a reason to find them not responsible. You have to dig a little further to try to find out whether there actually was an instance of non-performance, whether it was actually the vendor's right and the state agency's wrong, because believe me, I have had instances where I have had state personnel just yell up and down about what a vendor isn't doing typically. And sometimes when I've delved into the facts, I found out that the state personnel weren't doing things that were necessary for the vendor to perform, or were expecting the vendor to do things beyond the requirements of the contract, or just circumstances that actually, if it's right or wrong between the state personnel and the vendor, it's the vendor that's right and the state personnel that are wrong. I've experienced it, so you cannot take it just at face value. So put the clause in there, have the vendors give you their experience, and again, I'm talking about things that happen in the procure stage. But if you have negative references, then you have to acquaint the vendor with the negative reference and give them the ability to, number one, explain what happened, why it wasn't their fault necessarily, or the alternative could be that they say, yes, in that circumstance, we did drop the ball. But here is why this time we wouldn't. And basically, they could explain that was our learning curve. And I'm sorry, we didn't perform as necessary for that one, but you can go back and ask so-and-so, the contract manager, in the last 6 months, we really picked up things, and we really got the thing in the last 6 months. So they should tell you that even though for the first 2 years or so we had problems, we learned it, we got it. And we now can provide the same thing at the level that we ended that contract with, and that's why you shouldn't judge us on our first part of the contract, you should judge us on the second part. So you can use it, you should have it in your solicitations, but you have to use it with proper judgment. And again, before you would find a vendor not responsible because of reports from another agency, you're going to talk to your assistant AG, and you're going to have the vendor have the opportunity for rebuttal.
And you would discuss this during the oral?
Discuss during orals. Or you can put it in writing. But that's whether it's in writing, whether it's in orals, it's still part of discussion. The vendor has to have the opportunity to basically know their accuser and defend themselves. Yes?
Gary said that the notice about past performance is in our procurements, but do we have to?
Sealed proposal procurements. It will not be in a sealed bid procurement because there is no evaluation for past performance. There can be a responsibility determination, but there will not be an evaluation. Go ahead.
Say that again?
It will be in your RFPs, your solicitations for competitive sealed proposal procurements. It will not be in your IFBs, your invitation for bids for sealed bid procurements, simply because you do not have a past performance evaluation in a sealed bid. You do not have evaluations in sealed bids. You can find them not responsible, but that is not an evaluation in the same sense it is in a sealed proposal. Does that answer what you... Okay. To be a disincentive, vendors need to believe there will be ramifications to non-performance. The disincentive is weakened if agencies don't follow through in the procure stage and check with other agencies on past vendor performance. So you put the clause in there if it's a sealed proposal procurement, and you actually check. And by doing this, and if vendors get accustomed to the fact you're doing this, it will help spur them to perform through a non-monetary means. No liquidated damages, not terminating for default, not failing to renew, just simply, here's the reason why you didn't get this contract. They'll get the message if during discussions they are questioned about the performance of other state contracts, or during debriefings they are told one of the reasons they didn't win was performance. Now, of course, they should have been given the opportunity to give a rebuttal, but even if they gave a rebuttal, that doesn't mean you still have to accept it in the end. And you can say, even though we brought it up, you gave us the reasons why you didn't think we should hold it against you. In the final analysis, we did. And so that was a factor why you didn't win. In such instances, vendors might try to intimidate the agency by filing a protest, but agencies must persevere in such circumstances if they are to get to the point that vendors really believe that proper performance of all state contracts is important. So we need to follow through. Bottom line, disincentives are just one tool to try to get proper vendor performance of state contracts. While they can be a valuable tool, there are also times when they have limited impact to affect proper contract performance. Often it is better to use incentives to try to improve vendor performance than disincentives, or both. So now we've talked about disincentives, and now let's talk about incentives. Incentives are not in 15 minutes. Maybe people will stay longer. Well, trust me, when we've done this before, no one has eaten the sandwiches. After multiple people have been handling the various things. Yes. All right, let's start incentives. We have that as a treat for this afternoon, the peanut butter and jelly. Incentives are easy in concept, but often hard to properly design and implement. The objective is to pay performance that exceeds what is required. The difficulty is devising incentives that are sufficient that the contractor will make a concerted effort to try to earn them, but not so high that the reward to contractors exceeds the benefit to the state or is unaffordable to the state. So it's the old Goldilocks. You want to do it just right. You don't want to incentivize them too much, where you're paying them more than the benefit you're getting, and you don't want to incentivize them too little, that it isn't enough of an incentive for them to do anything more than what the contract requires. The just right balance that isn't paying too much and still gets the extra performance that you want. Again, easy in concept, hard in implementation. Sufficient incentives to motivate the contractor. When the contractor competed for the contract award, it quoted a price to perform the requirements of the contract. So we have said what they have to do, or we have just said the objective, and they've told us in their proposal what they intend to do. And if we accept their proposal, then that is now the contract. They've given us a price to do that level of performance. And so if we want more performance than that, we may have to give them more money than what they quoted to meet the requirements, since we now would like them to exceed the requirements. Logically, the contractor will require a higher payment than already quoted to perform at a higher level than required. The contractor wants its higher performance costs covered. If it costs it money to do more, it wants those costs covered, and usually it wants something besides just covering its cost. It wants to make more money for more performance. Example, if there is a contract, and I realize I will leave you with this, and you can mull it over the break, because one of the things I realize is I will read these off to you, and probably, I don't know if I can say you're going to get lost, but it's probably, you're going to have to think about these and look back at them a while to really get the full impact of this particular example. If there is a contract for drug treatment for parolees with the objective of reducing the recidivism rate of parolees, i.e. keeping people on parole from getting off, violating their parole and getting put back in prison. So we have an objective to keep people from going back to prison. And since we know that there is a high incidence of drug abuse, drug addiction for people in prisons, etc., it has been found, it has been found that if you can keep people off drugs, that has a very great effect on reducing the recidivism rate, people going back to prison. So if there's a contract for drug treatment, so we're going to have a contract for a vendor to treat various people who are on parole to try to get them off drugs, on the premise that addiction is a key factor in committing crimes, and we're making this premise. And I don't know if this is a factual premise, this is a premise I invented. And I will emphasize that I invented. So if, let's say, when there's no drug treatment, 40% of people on parole do something bad, go back in prison, But if there is drug treatment of a normal nature, only 25% of the people on parole will go back and use drugs and go back into jail. You can see there's a 15% variation that drug treatment has a 15% beneficial result in that respect. So we're expecting a normal drug treatment program to have at least a difference to result in 25% recidivism rate rather than higher. All right, so that's the premise. And if we want to incentivize this to go beyond and get it even further than the 25%, so we want to try to get the vendor to do more aggressive treatment or something of the nature that's going to even have less than a 25% rate of recidivism. If we say, for instance, the contractor will receive an extra 1% of the contract amount for each full percent of reduction in the recidivism rate below 25% 2 years after the contract ends, because you always have to have a target. And it isn't good to say, if no one has gone back to jail 2 months after the contract's over, because most people within 2 months are still going to be okay. You have to give it a point in time when people really start slipping off the wagon, so to speak, where it's going to have a real impact. So let's say that since normal drug treatment is 25% recidivism, if you are at 24%, that means you've done better than expected performance. We'll give you a 1% extra payment. If you do 23%, we'll give you 2%. 22%, we'll give you 3%, et cetera, of the original contract value. And for the scenario we have put up there, the vendor, even though the contract will be over at a given point in time, for them to demonstrate what recidivism there has been 2 years after the contract, needs something in place for tracking for 2 years. Some implementation to do something to track what happens after they get out of their program. And so they will have an expense. And first of all, if the expense will not be recouped by the contractor, and so there will be an expense for them to do tracking. And the situation that the vendor is confronted with, because what you're doing here is you're theorizing at the planning stage. You're trying to think of an incentive, and you're trying to think of whether the incentive that you're thinking about, which is this example, will produce a result from vendors. So we're thinking about giving them this 1% more contract value for each 1% reduction. And now we have to think, okay, if they do this, they have to do tracking for 2 years. And if you're the vendor, okay, you're going to have an expense to do tracking for 2 years. And that's a certainty. You know you're going to have some level of expense for 2 years, and you're not getting paid anything to do that. You will get paid something if you achieve at least a 1% reduction. You will not get paid anything if you don't achieve a reduction. So from a vendor standpoint, you have a known expense, you figure out how much it's going to cost you to track, and you have a potential payment for that, the potential of 1% of contract value, which may happen or may not happen. So it depends on how confident you are that you can really affect the recidivism rate below 25%, plus how much it's actually going to cost you to do this 2 years of tracking. And I throw in that run out because sometimes there's a requirement for the vendor to do that as part of the contract, so there is no extra expense. Yes?
You have to remember, you have to build that into the total cost of your contract too, right? If you've got it allowed in your budget, even if you don't use it, you've got to make sure you've got that money somewhere, right?
Exactly. If you have this in the specifications so that potentially a vendor can get more money, you have to be prepared to pay that money. So again, there has to be the anticipation in the out years of the contract that either you're going to have that amount budgeted or that you know that if they earn the incentive, you'll take it from somewhere. So yeah, what you're not going to do is say this, have the vendor work to get it, and then, well, you can't tell them, I don't have any money to pay you now. Because then they're going to file a claim and they're going to get it, and you'll be told, find the money. Let's see. Contractor may know that supports are needed to help former addicts. So aside from doing tracking, they may know that it's not just good enough to do tracking. They actually have to have people in place, people to take phone calls, people to be a big brother, big sister, etc., to help people over the rough spots. So that means they may have to be paying staff to help people that have graduated from the program continue to be off drugs for these 2 years. So let's say you're the contractor and you figure that between the tracking that you have to do and the supports you have to do, that it will cost you $50,000 for 2 years just to be at the point of earning an incentive. So that's a premise now. I'm the contractor, I figure it's going to cost me $50,000 to try to qualify for an incentive that's built into the contract. If historically, even with supports, there is little success after 2 years with recidivism below 25%, and the lowest recidivism rate ever achieved with the population after 2 years is 20%, the best the contractor can reasonably project in terms of recidivism reduction is 5%. And let me say that again. Historically, there's very little success below 25%, and no one has ever done better than less than 20% recidivism. So that means the vendor's standpoint, the most they can get with effort of expending this $50,000 is a 5% reduction, maximum. 5% reduction with being paid 1% for each 1% below 25% means they can get a 5% of the contract value as an incentive. And let's see. And they have a known expense of $50,000. So if the contract, somewhere I say if the contract is $1 million, 5% is, well, let me just go through. 10 times. Previous? Okay, now. $50,000 more in incentive payment. Let's see. 5% reduction is $50,000 incentive payments, but the contractor projected $50,000 in cost just to try to lower. So the best in the scenario I've set up here, and somewhere I need to put the contract value so you know what 1% is, and I think 1%. 1%.
Slide number 30.
10,000.
330. Okay, so I missed 330. 1 million. That was the magic number I was looking for because I knew I'd put that in there somewhere. It's a $1 million contract, so each 1% is $10,000. That's how we got to the math later. So if it's a $1 million contract, 1% is $10,000, and the best the vendor can hope for is a 5% reduction based upon what has ever been done before. The most they can expect to get as incentives is 5%, which means $50,000, but they've already projected it's going to cost them $50,000 just to be in a position to earn the incentive. And so what the contractor in that scenario is based with of, do I even bother to try if I know I'm going to spend $50,000, I may end up not improving it at all and have $50,000 I spent with nothing to pay for it, or if I spend it and I do wonderful things and get $50,000 incentive, the best I've done is break even. So what this is trying to emphasize is, in this example, a vendor is going to decide this is no incentive at all. It has not sufficiently incentivized a vendor to try to perform beyond what the contract required. But now taking this a little further, it is a known circumstance that housing a prisoner in the state prisons costs approximately $25,000 a year. So, all right, every prisoner costs about $25,000. So paying even a $10,000 incentive to keep one person out of prison still has a payback to the state of $15,000. So knowing that, we could go back and try to have a more lucrative incentive than 1%. The whole thing that we're trying to illustrate is the difficulty in trying to do projections, the difficulty in trying to figure out what will be an incentive that, number one, will spur a vendor to try to get that incentive, but number two is going to be worthwhile to the state. In this particular example, with knowing that there is a $25,000 payback for every person that doesn't go to prison that we can somehow document that otherwise likely would have gone. We know there's at least $25,000 to play with to try to incentivize a vendor to try to keep them from going back to prison. So it would be worth the state's while to increase a $10,000 incentive payment, if need be, that 1%, to try to achieve the lower than 25% recidivism. And we gave some examples there. So you can read that, but that basically is the concept. Does that illustrate anything? Does that work? I might ask you that after lunch to see whether, I know you're going to go to lunch and you just keep pondering upon this. So why don't you go to lunch, we'll come back, we'll do a couple other slides, and then we'll show you an example of an incentive that worked, but it worked and it didn't work.